Okay, today we will discuss about the variable costing and the absorption costing. Variable costing is very much similar to that break-even statement that we had made by ignoring the fixed cost, or we take the fixed cost at the end. But absorption costing method is that it is known as full costing method. Full costing means that is the overheads are all fixed overheads are also taken in it. So here is the definition: absorption costing, also called full costing, which assumes that product absorb all the cost incurred to produce them. In short, this chart will summarize it. That is absorption costing. In absorption costing, product cost comprises of direct labor, direct material, variable overhead, and fixed overhead. But in case of variable costing, product cost comprises of only, as the name suggests, only variable cost, that is direct material, direct labor, and variable overhead. And fixed costs are considered as the period cost. Here is another example of absorption costing and variable costing. Variable costing is also known as marginal costing. So if we see the name marginal costing, it is seen as the variable costing. That is only variable costs will be taken in the product cost. And in absorption costing, variable plus fixed overhead will be taken in the product cost, whether it is total cost or whether it is per unit cost. So here it is, the absorption costing means full costing. That is, we have taken the direct material, we have taken direct labor, we have taken the variable overhead, and also we have taken the fixed overhead, and that makes the unit cost of $25 per unit. But in case of variable costing, we only took the variable cost, that is direct material, direct labor, and only variable overhead. We haven't taken the fixed overhead. So our per unit cost would be variable, that is $15. So this is the basic difference between the absorption costing and variable costing. Now we will be doing some questions relating to it. I will write it here so we have an idea. That is for it will be given as standard cost card. Direct material $3 per unit. Direct labor $2.25 per unit. Variable FOH, it is very important that we should have given the both variable and the fixed. So variable FOH $0.75. So fixed FOH is 1.25, and hence this will make our total manufacturing cost of $7.25. You can also check it with your calculator. Then now we have given in further in this question we have given further data, that is the normal capacity of this producing unit is 240,000 units per year. So normal capacity is equals to 240,000 units per year. And fixed FOH, that normal capacity is equals to $300,000 per year. This is given in amount. Further, we have given fixed marketing and admin expenses. Fixed marketing and admin expenses $60,000 per annum. And variable marketing and admin expenses are $3,400, comma $3,600, comma $4,000, comma $3,000. These are per month given for first month, second month, third month, and fourth month respectively. Okay, sales price per unit is equals to $10. Now we have given the data about sales and productions for the 4 months. Description: first month, second month, third month, first, second, third, and fourth. First month, second month, third month. Beginning units, units produced, units sold. And ending inventory. If we haven't given ending inventory, we can also calculate it through the calculation, that is beginning plus produce minus units sold. So we have to see whether we have a remaining ending inventory or all produce is sold. So there will be amount, that is dash 17,500, and also 17,500. So all produce is sold, therefore we haven't any ending inventory. So the ending inventory of first month would be the beginning inventory. There is no ending inventory, so there wouldn't be any beginning inventory as well. In month two, we have produced 21,000 units and we have sold just 18,000 units. So we would be having 3,000 units in the ending inventory balance. And these 3,000 units will be the opening inventory of the third month. Please remember it. 19,000. We have sold 21,000. So 19 and 3, it makes 22. Overall available units were 22, and out of those 22, we have sold 21 units. So we have got ending balance of 1,000 units. Again, these 1,000 units will be the opening units. Then we have produced 20,000 units, 16,500, ending will be 4,500. So this is the data available with us. What we have to do, we have to prepare a statement, that is income statement. On two bases: marginal costing basis and absorption costing basis. The difference is that in absorption costing, we have to take the full cost, that is total manufacturing cost would be 7.25, obviously, and in the absorption cost, oh sorry, marginal costing, it will be only variable aspect. So we will start sorry, we will do for 2 months initially for marginal and 2 months for absorption. Then we will see what our result would be. So if you want to take the picture of this question so that you can refer to the solution, you may take it, or otherwise it would be fine. I will continue with the answer. Okay, now we will be preparing income statement on marginal costing. It is known as variable costing method also. It is also known as direct costing method. That is, absorption is the full costing method and marginal is the direct costing method. Then now we will have 2 months. That is month number one and month number two, and here will be the data. Month one, month two. So income statement obviously starts with the sales. So we will make the data of sales. For first month, we have sold 17,500 units at the rate of $10 per unit. That is 17,000 into 500. That would be 17,500 into 10. It would be $175,000. This is for your understanding. In month two, we have sold 18,000 units, so it would be directly of $180,000. Yeah. Now after that, in financial accounting, that would be appearing after sales would be cost of goods sold. So here also it is income statement. We will incorporate cost of goods sold, but it would be only and only on the basis of variable. So we will write variable cost of goods sold. In cost of goods sold format, if you remember, we take first opening stock. In month one, there was no opening stock, and similarly in month two, there was no opening stock. Therefore, their values would be nil. And in normal accounting, financial accounting, after opening stock, we add purchases. But in case of this manufacturing account, we are not purchasing, we are producing. So that is cost of goods manufactured will be included. So we will add cost of goods manufactured. Now, this cost of goods manufactured will purely on the basis of variable cost. So, material, it would be 17,500, that is produced, multiplied by material cost 17,500 multiplied by labor cost, and 17,500 multiplied by variable FOH cost. So material, labor, and variable FOH. These costs would be 52,500, 39,375, and 13,125. You can also calculate it. Like in month 2, we have produced 21,000 units, so they will be individually multiplied and their values would be 63,000, 47,250, and 15,750. So opening stock at purchases or goods manufactured, they will combinedly make goods available for sale. So this total and this total would be 105,000. Let me calculate. It's 105,000 and 126,000. Now there will be goods available for sale. This one and this one will be added. So it would be goods available for sale and also it would be 105,000. And this would be also 126,000 because we haven't any opening inventory. Now after that we have to deduct opening stock at purchases. Now we will be deducting less closing stock. Since we haven't any closing stock, so their values will be also nil. So our variable cost of goods sold will also be the same. So we will write it as variable cost of goods sold. Hope you are getting it. It is not any new concept. One minute. We have a closing stock in the second month. Yes, we have closing stocks in the second month 3,000, and this will be also from the produced units. So their total cost would be what? 32.25.75. That is the on the basis of variable cost. So it would be 3,000 multiplied by 3 plus 2.25 plus 0.75. 6. The total of 6, 3,000 into 6 would be our closing stock in the second month. 3,000 multiplied by 6, that is 18,000, and that closing stock is deducted So it would be 126 minus 18,000. The cost of goods sold would be 108,000. Yes. Then now variable, we are deducting just variable cost. So the resultant would be our CM. Sales less variable cost is always what? Is always our CM. So it would be CM, contribution margin. Contribution margin sales 175,000 minus 105,000. CM would be 70,000. And 180,000 minus 108,000 CM would be 72,000. Now, if we see in the question, that is very important. If we see in the question, we have given some variable admin and selling expenses. Now, just recall the financial accounting methods that we have got the gross profit, and after that gross profit, we deduct operating expenses, marketing and selling expenses, then we get net profit. Similarly, if we have some variable marketing and admin, expenses, then this CM would become gross CM, and after that deducting variable and marketing expenses, we will get net CM. If we have variable marketing and admin expenses, so we have got variable marketing and admin expenses for the first month, they are 3,400 and second month 3,600. So 3,400 and 3,600. So our net CM would be, after calculating this, 66,600 68,400. This would be our next CM. Now, as per our way that we have done break-even statements, after that CM, we deduct the fixed cost. Now, all the fixed costs, whether they are the production, manufacturing fixed costs, or whether they are the variable marketing and admin basis, they will all be deducted after net CM, and then we will get our net profit. So we will deduct fixed cost less fixed cost. First, fixed FOH. And second, fixed selling and admin expenses. Then, now what about fixed FOH? Fixed FOH is treated as a period cost, expense out. So expense out would be not as per the manufacturing rate, because if we apply that rate, then it will be the manufacturing cost. For this, we have to see the fixed cost that is at normal capacity, or the old definition, that is fixed cost remains same at all levels. Now for that, we have to see that. Now look at this thing very carefully, that for the normal capacity of 240,000 a year, we have got a fixed cost of 300,000 per year. So if we convert 3,000 for per year into per month, because we are making that statement for 1 month, so 300,000 divided by 12 would be 25,000. Now, as per marginal costing, 25,000 would be same for all months. because they are period cost, they we will not take as the production cost. And secondly, we have got the fixed marketing admin expenses 60,000 per annum for 12 years. So 60,000 divided by 12 would be for 1 month, and that would be worked as 5,000. So fixed marketing and admin selling expenses would be 5,000. So these two would be the fixed cost and treated as period cost in marginal costing, not as a product cost in the absorption costing. So 30,000 here and 30,000 here. And when we deduct it, 66 minus 30,000, that would be 36,600. And 68 this minus this. This minus this. 68 400 minus 30,000, it would be 38 400, and it is the net profit. Then so this would be the sequence of any statement under marginal and absorption costing. Now similarly, we will make this statement, the statement for the 2 months for the absorption costing. Okay, let's start absorption costing. That is full costing. Month one. Again, sales would be remain same. So you can refer it back. That is sales for 1 month 175,000, and for month two would be 180,000. Now obviously after sales it would be now cost of goods sold. Cost of goods sold would be overall cost of goods sold, not like variable cost of goods sold. So cost of goods sold will again start with opening stock. And since opening stock is not here in both months, so it would always obviously be zero. Now sales less cost of goods sold consists of opening stock, add purchases. We haven't purchases, we have the manufacturing cost, and it would be manufacturing cost, total manufacturing cost. So no need to write variable manufacturing cost. So manufacturing cost would comprise of what? Material, labor, FOH, and this FOH would be what? Fixed plus variable. One thing we can do is that show separately either, or either as a combine of this. That is 17,500 multiplied by 7.25. If we do this, it will also be acceptable presentation. There will be no issue with that. So if we write separately, that is material would be 17,500 into 3, that is 52,500. Labor 17,500 into 2.25, 39,375. Variable FOH 0.75 into 17,500, that is, I am writing it separately. Let's do it in like this way. Variable FOH, fixed FOH. This will give you more comprehensive understanding. Variable FOH 13,125 and fixed FOH 21,875. So this all will make our cost of goods sold. And the total will be 126,875. Now I'm writing the month to directly. It would make 152,520. Let me write fixed FOH because we have to do something with that. It would be 26,250. Okay. Now this is cost of goods sold. So we have opening stock, add cost of goods sold. We have goods available for sale. Obviously, there is no opening stock, so it would be same 126,875 and 152,250. Now, less closing stock. We haven't such anything in the first month, but in second month we have 3,000. Now this 3,000 will be multiplied by 7.25, that is full costing. So its value would be 21,750. Now this would be cost of goods sold, 126, 875, 130,500. This would be subtracted from sales. But before that, we have to do one thing. Remember, we have done the over or under applied FOH adjustment in the cost of goods sold. So there is something in full costing, absorption costing. We have to see that about the fixed FOH, because on the normal capacity. Now listen to this very carefully. On the basis of normal capacity, we had estimated that our FOH would be 25,000 per month. And as per the definition of that 25,000 fixed cost, fixed FOH, it has to be remain same. Now in the production we have applied. This is the budget applied. Now we have got the actual, that is at the rate of 1.25. So this difference of that we actually applied 21,875 and the budgeted 25,000, which needs to be adjusted. So we have to take the amount towards 25,000. Just remember this. We have to take the amount till the normal budgeted normal capacity fixed FOH. Here 21,875 is now under applied. So we will have to add to make it to 25,000. Here it is 26,250. So we have over applied, we will lessen it, we will less to make it to 25,000. So it is the line which is very important. I am first highlighting. This highlighted line will be very important in absorption costing after cost of goods sold. I am repeating, we have to adjust the fixed overhead applied or under applied, or we have to overhead adjust fixed overhead variance difference. We may call it difference in the absorption costing. So we will write a line adjustment of over, because over will be lessened, or under fixed FOH. Now 21,875, and to make it 25,000, we will have add we will have to add 3125. Clear? So this will make our, don't write negative, you will get confused here. So this will increase our cost. So our adjusted cost of goods sold, now it would be adjusted cost of goods sold would be increased because we have under applied and we have to adjust our cost expenses. So our cost of goods sold adjusted would be 130,000. And here in month 2 we have to adjust 26,250 to 25,000. We have to lessen, we will less 1250. So our cost of goods sold would be adjusted towards the lower side, and hence our profit will be increased. That is, it would be 129,250. Now this adjusted cost of goods sold will be minus subtracted from the sales. So it would be our gross profit. That is 175,000 minus 130,000. It would be 45,000. And 180,000 minus 129,250, that is would be our 5750. Now in normal accounting, if we have calculated gross profit, we will deduct all the selling and admin expenses. Now here we will deduct both fixed. Since we have taken the fixed FOH manufacturing here, we will not deduct here. Just like we had deducted here, it will be not done here because we have made fixed FOH as a part of product cost. So the only period cost would be marketing and selling, whether variable or fixed. So we will less marketing and admin expenses, whatever from the name it is. And they are obviously, one is variable and others are fixed. So variables are 3,400 and 3,600. Fixed are fixed 5,000 per month, 5,000 per month. And after that, these two will be deducted from this. These two will be deducted from this, and we will get net profit 36,000. And here it would be 42,150. Then, so this is the difference of margin and absorption, and you can see similar thing, similar costs Masses different, but in one first month 36,600, 36,600. Profits are same. But in month two, profit are different. Similar inventory, similar cost, 38,400 and 42,150. Under absorption costing, our profit is greater. There is a reason in it. But initially, what you have to do, you have to complete the remaining 2 months for marginal and for absorption as well. That is taking the data from this and continuing from second month to third month to 4 month of the marginal costing and for the absorption costing. Then we will see the reason behind the change in the profits. Okay, this is a very simple topic and this is the comprehensive question. After that, we will see book reading or book question and this will be complete.